We got a headline today that it is time to talk about. The banks are changing their tune these days. We've gone from a beginning of the year where we all thought that interest rates are going down to now Bank of America and Deutsche Bank are predicting rising interest rates. They got a couple different predictions. We're going to talk about what they are. We're going to talk about what that means. We're going to talk about what it means to real estate investors. And of course, we're going to give you some data with perspective with it. Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Fantastic to be with you today.
So let's talk about what's going on, right? So we've got these headlines from, you can see it all over the place. Bank of America, Deutsche Bank specifically. Bank of America is predicting 3 interest rate hikes coming up with this new Fed chairman coming in, and a total of 75 BPS, and which you're going to explain to me what BPSs are. And then Deutsche Bank is predicting 50 BPS, right? So interest rates are coming up. Big change from kind of like how we started this year. This has been an ongoing conversation inside of the Not Your Average Investor Show community, how kind of like we went from like predicting rates dropping to now inflation is an issue again with the war, with oil prices and these different things that are affecting commodities. The Strait of Hormuz, which had a shot at being open for a little while here, seems to be closing down again. And then of course we just have the AI joblessness apocalypse hasn't come. Jobs are still strong, right? So I don't know, man. When you're hearing these headlines, what are you thinking about?
Just thinking how much the world can change and interest rate expectations and really all facets of the economy can change from not just year over year or quarter over quarter or month over month. It really feels like week over week now.
Yeah.
And there's definitely a different tone when it comes to where we think interest rates are going to be. Like you mentioned, towards the end of the year when we were putting our predictions together for this year and in the beginning of this year, we thought we were pretty confident that rates were going to come down. Maybe not a lot, but the idea that we would be sitting here talking about 3 potential rate hikes from the Fed, from a trusted institution like Bank of America, was just off the table. And now I don't know if it's going to be 3. I don't know if it's going to be 1. I don't know if it's going to go up or down or whatnot, because nobody knows. And I think that's the real theme. From week to week to week, it changes so much. But the backdrop now is that we are all bracing for rate increases, and I think that's noteworthy. And the way that it affects everybody in the economy is that means borrowing costs on almost everything go up. So in an era right now where affordability is a real challenge, if we're not putting our investor hat on right now, we're just thinking about, as citizens of this country, when the Fed is potentially going to raise the Fed funds rate, that raises the borrowing costs on every facet of our lives. And so that's not a great thing for the average American. And as we think about it from an investor lens, that absolutely correlates to investments not producing as much cash flow because the borrowing costs for every investment or every company goes up. That means it's that much harder for them to produce a net income on a monthly basis and a return on investment from that cash flow. So not great news that we're all bracing for the worst here, but the silver lining is tune in next week because it might be different.
Yeah. Silver lining is we are not off the roller coaster, right?
No.
So I get you there, man. You said a lot of things. I'd like to start kind of like from like highest order of magnitude, right? And to me, I go to the place of why would we be raising interest rates? Why would we want borrowing costs to go up? And I think it comes with kind of like the last thing I said. Job market is still really hot. And we've been kind of like talking about over time that at the end of the day, the Fed has a double mandate of controlling inflation and keeping jobs going, right? And if if there isn't, if like everybody's employed and inflation's going up, then the only thing that you can really do is raise rates so that maybe you can slow down the inflation because the borrowing costs go up in order to buy goods. Borrowing costs to like hire people also go up. That's kind of like what you're seeing of like what the movie here is and why it's happening, what they're hoping to do?
Yeah, let's kind of start with how we're affected the most, which is interest rates on our mortgages for our rental properties.
Yeah.
There's the biggest driver of this is what is a similar investment producing for the same investor who's going to be on the other side of that mortgage payment that we make. So we have to remember that when we secure a mortgage with a set interest rate, there's an investor on the other side who is saying, yeah, that's a great risk-adjusted return for me. I'm going to lend you that money. And so what investors who are investing in mortgages look at is they say, well, what is a similar investment that I could invest in, and what's my rate of return? Well, a very similar investment to them is a 10-year treasury,
Mm.
10-year treasury bond. And so when they look at that, they say, well, what's my rate of return on the 10-year treasury? What's the yield on that versus what yield could I get as a lender on a mortgage? And that's why that is the biggest determining factor of what our interest rates are. And so that's actually the biggest driver of our interest rates. The next, a subsequent or an indirect relationship is what does the Fed do? Because the Fed has an indirect relationship, but it also affects 10-year treasuries and everything else. So if we're looking at it just as like the 10-year treasuries, the biggest thing that we need to pay attention to as affecting our mortgage rates, what investors in the 10-year treasuries don't like is inflation. Because when there is inflation and inflationary expectations, that erodes the value of their investment. And so they don't like inflation. So we see a lot of inflationary things potentially happen in the economy now. And when we think about inflation, like you mentioned, when you have an economy that has low unemployment, well, that is an inflationary, that can be an inflationary measure just by itself. People are working, people are earning, people are spending. And so that's one thing that we're seeing now. The job market, the labor market is a lot stronger than people expected. So that's an inflationary type of thing. But
Hmm.
then there's all these other things that are happening in the world that are inflationary. The easiest I think to understand is just the cost of oil, the cost of energy. When
Hmm.
we have this conflict with Iran and the cost of oil goes through the roof, well, it's very easy for us to see, and then others who are investing to see that when the cost of oil goes up and our costs at the tank go up for gas and everything else in this economy is really based on energy to get it there and to produce it and whatnot, well, then they see that as being very inflationary. And
Hmm.
so, all that to be said, it comes down to inflation expectations and the labor market. And so, the 10-year treasury is really affected by that right now. And that's why the 10-year treasury yield has gone up. And that's why we have seen our 30-year mortgage rates go up. Um, so that's the main driver. The secondary driver is what's the Fed doing? And the Fed now is also signaling that they are likely to increase the Fed funds rate. And so when that happens, that also affects investors who are investing in 10-year treasuries. That requires a higher yield for them. That drives up the yield, the interest rate for us on 30-year mortgages. So all things right now are pointing towards the signs of higher inflation and low unemployment, higher employment, and the Fed and investors in 10-year treasuries and everybody else who invests in 30-year mortgages all look at that and say, I need a higher yield for me to invest in a 30-year mortgage. The way that hits all of us is we have to pay higher interest rate for our 30-year mortgages, and that's really where we sit here today.
Really good summary. I like I'm almost like I'm reading these headlines and I'm immediately just kind of like conflating what the Fed rate is versus the mortgage rates versus all these different things. I think it's all one thing. So you did a good kind of like separation of the two, right? Like mortgage rates have kind of gone up and down in their own thing based on different conditions and different things that have happened, while the Fed funds rate has essentially stayed somewhere around the same place. And now we're talking about the Fed funds rate that is going up, two or three times, 50 or 75 BPS. What's BPS again, GC?
Bips, it just stands. So 100 bips is equal to a 1% change. So 50 bips equals a 0.5% increase to your rate, in this
Got
case, a
it.
mortgage rate.
Got it. So basically, Deutsche Bank is saying 0.5% rate hike. Bank of America is saying 0.75% rate hike, essentially.
Not exactly. If only it was that simple. What they're
Yeah.
talking about is they're likely to see a 40 bips or 50 bips or 75 bips increase in the Fed funds rate.
Okay.
That's what they're projecting.
Got it.
Now, an increase in the Fed funds rate does not always correlate to an increase in our mortgage rates.
Mm.
That's why we talk about the Fed funds rate and what they do as being indirectly related to our mortgage rates. So there are many examples where the Fed has increased the Fed funds rate and mortgage rates have stayed flat or even gone down. And the other is true. The Fed has lowered the Fed funds rate and our mortgage rates have actually gone up. So what Deutsche Bank and Bank of America are projecting does not necessarily mean that they are saying that there's going to be a 40 bips, 50 bips, 75 bips, 0.5%, whatever. Let's just keep it simple. 0.5% increase to our mortgage rates. That's not exactly what they're saying.
Got it. Okay, cool. I was asking
Clear
for a
as mud,
friend.
right?
For the record, I was just asking for a friend. I knew what it was. Peter Skaggs in the chat, he's chipping in. He's also explaining it really well. So I really, really appreciate it. Just to get everybody on board with what this is, you mentioned something, how this affects us as investors, how this affects the real estate market. This is a positive force on interest rates, essentially, right? Like we expect that if this happens, it's likely to believe that interest rates will go up and borrowing rates for mortgages will go up as well. Can you kind of like talk me through how that affects the different kind of like real estate ways that you invest in single family homes, right? I, from what I understand as a rental property investor with JWB, I've bought a home. I have a 30-year mortgage on it. I have three of those actually with JWB, and then I have my own like duplex over here. But they're 30-year mortgages. My costs are not going up, but costs around the ecosystem are going up. So how does that affect me as a rental property owner right now?
Yes. So if you're like Pablo and you already own assets with JWB, or you're probably like most rental property owners who have mortgages that are fixed, this news doesn't affect your monthly cash flow. So your mortgages are likely fixed. What is happening in the mortgage market does not affect you directly because your monthly mortgage payment is fixed. That's one of the best things about rental properties. Your rates or your returns go up, your rental incomes goes up, and home price appreciation and all that goes up, but your biggest expense, which is your mortgage payment, stays flat and it's fixed. So if you're like Pablo and you're seeing that rates are potentially likely to go up in the future, that doesn't affect your monthly cash flow. In
Mm.
fact, your monthly cash flow has probably risen so much just because I know Pablo's portfolio so well. He has
Yeah.
a lot more cash flow in his portfolio today than when he started 3 years ago because his rental income has gone up. So, in that kind of myopic sense, doesn't affect you. However, we're all affected by what interest rates are doing. And so if Pablo is looking at his biggest profit center, which is not net rental income, but is looking at home price appreciation, one thing we know is that when you see higher elevated interest rates, it suppresses demand. And so home price appreciation that would have otherwise happened for you, Pobs, likely
Mhm.
is suppressed, which is what we've been seeing for the last couple of years. Home prices have basically been flat in Jacksonville and in most parts of the
Mhm.
country. And that what's happened there is that it's not like people don't want to buy houses, especially in Jacksonville, but people are on the sidelines and they're saying, well, I'm going to wait for this interest rate to come down. And so it suppresses demand. And then likely when interest rates come down, that's when we'll see increased home price appreciation. So directly, you're not affected, Pablo, on your specific properties because you have fixed rate mortgages. Indirectly, it affects your home price appreciation. The longer that interest rates stay elevated, and if they continue to go higher, we would expect more suppression of demand, which will be released on the other side as interest rates do come down.
So this is more and more of what we, like we've called it like a coil effect, right? Like the when interest rates are high, it kind of like compresses the coil and keeps compressing it. When interest rates drop, the coil expands. home price appreciation comes back. We were moving into a period where we were expecting that coil to kind of like start to uncompress a little bit. Now it seems like it's not compressed, it's not uncompressing, it's not staying the same compression. It might continue to compress even further. Is this like, do you see this as something that is, you mentioned delaying home price appreciation, you mentioned suppressing demand. Do you see this as still kind of like in the narrative of like it's only going to make it, it's going to increase demand, increase home price appreciation when it comes back around kind of thing? Are we still there or are we beyond that these days?
I do. I think the longer interest rates stay higher, the greater the rebound effect will be on the other side of them. However, I'm learning some new stuff. I think we're all going through some of this together. This is the only time in recorded history that interest rates have gone up this fast, stayed this high for this long. So really interesting. I was just looking at the market data for June. Would you know that even though we've got all this craziness going on in the world, and even though interest rates are higher than we all want, they've been that way for forever, would you know that we had 4.9% home price appreciation year over year in Jacksonville in June? 4.9%. That is, we set the single highest price in the history of Jacksonville real estate in June of this year. So just last month. And if we look at a smoother, longer term appreciation metric just to make sure it's not, slighted by one really strong month or whatnot. And even over the last 6 months on average, we've had about 2.3% home price appreciation in Jacksonville. So interesting. I do think that the coil effect is still there, but what may also be happening is that, people can only sit on the sidelines and not buy for so long before life happens. And it's
Yeah.
just better for them to be able to buy and not sit on the sidelines. Side note, it's always better to buy and then just refinance later, even if you think interest rates are too high. But not everybody understands that. So this might just be a little bit of maybe this is just becoming a new normal for people. I think we're looking at data really from the last 3 months, 6 months. So I'm not jumping to that conclusion yet. But what I am seeing and what we're seeing a lot over the last few months is that sales are picking up. Home price appreciation is noticeably higher than it was a year ago, even though interest rates are higher. So, interesting, interesting. Coming to a quarterly market outlook to you soon, for sure.
Yeah. Interesting, man. Yeah, I guess it makes sense, right? Like as you know, I was an economics major in at University of Florida. Don't really think I learned anything super applicable until now that I get to talk about it on the Not Your Average Investor show. But we see this idea of supply and demand and what it does with price, and there's these like one linear vector kind of like movements where if interest rates go up, then demand goes down, therefore price may go down. But when you start to like put the whole picture together and you start thinking about single family homes, it makes sense that for a while it did what we expected it to do, right? Like it slowed down home price appreciation. Um, and at a certain point, the idea of like market forces and what we know about economics comes up against a first principle, which is a necessary asset, right? Like a necessary good, which is housing for people. So it's like an unstoppable force meets an immovable object kind of thing. Like if interest rates going up are like an unstoppable force that will suppress demand and suppress activity and all these things, at some point it's going to meet an immovable object of like, hey man, at the end of the day, if I'm someone that's been sitting on the sideline saying I don't want to make the move now because of this unstoppable force that's happening right now, at the end of the day, if I got to move, I got to move and I got to make the best decision for me. And people are kind of like overcoming it and being like, all right, well, this is just, shelter's a necessary thing. And I need to do what's best for me and figure the rest out later, which is one of the things that we talk about of this, like investing in crucial infrastructure and necessary things for people, which is what single family homes are. And that is starting to, now that we've experienced this for so long, we're starting to see the effect of that overcome the effect of like, market sentiment.
Maybe. It's still early, but that makes sense to me for
Yeah,
sure. You know,
yeah,
at the end of the day, you know, if I have a new child or if I have a job or if I, you know, I get married or something or, you know, I'm going to solve that problem with, and many times solving that problem might need a new house or a bigger house or a smaller
yeah.
house and whatnot. So yeah, I like the way that you describe that.
Yeah, or I moved to or I moved, to Jacksonville 2 years ago. I know I'm gonna stay here. I've been waiting for interest rates to drop, but at the end of the day, like I need to have stable housing that I'm gonna be living in, and I need to know where I'm gonna live and not, not be,
Right.
at the whim of whatever, right? So yeah, so at some point, higher order decisions come into play. So that's GC. That's a good kind of like macro understanding of the market, how this is kind of affecting the things. A good understanding is how me as a rental property current investor, how my assets might perform. Let's talk about now about anybody that's thinking about expanding their portfolio or getting into rental properties right now. Is this a bad time to buy now because we've been at a high, it's going to continue to go high, or are you seeing the idea that like, maybe we've met this part where like the market's over, kind of like the anchoring to the past, and they're just making better decisions, so we're going to go back into like a more normal kind of like scenario?
Well, everybody on the show knows me long enough now. Been doing this for 6 years. There has never been a time I've said it's been a bad time to buy, because I know how this thing goes. And buying these assets, holding on to them, and then seeing how they can change your life over a 10-year period or longer is life changing. And so it is a good time to buy, but it's a whole lot harder today than it was, you know, even 6 months ago when we had a little bit of interest rate relief, or certainly a few years ago. The challenge is that your cash flows are much, much harder to come by. Your positive cash flows are much, much harder to come by. And people, at least our clientele, doesn't like to get into an investment that they are going to have to pay money towards on a regular basis. I think we're all students of Rich Dad, Poor Dad, and I think Robert Kiyosaki had the best explanation of an asset and a liability when he said, an asset is something that puts money in your pocket every single month, and a liability is something that you pay every single month. And so, um, it's a simple explanation, but I just think it makes sense. And so, if we're relating it here to rental properties, well, now as interest rates are higher in today's current interest rate environment, as interest rates are higher, that might mean that positive rental or positive cash flow rental property that you may have considered may have gone from positive to negative cash flow in the first year. It might be negative cash flow for your first 2 years or even longer because interest rates are no longer 4% and now they're 6.5%. And then in other markets that are really cash flow heavy, other markets used to talk about, oh, I can produce $300 a month in cash flow or $400 a month or these crazy numbers. Well, cut those numbers in half because, when you take interest rates and you jump from 4% to 6.5%. The idea, if you are an rental property investor and you love this asset simply because of net rental income, number one, you're missing the point, and number two, you're not going to be happy. This is making it much harder for the numbers to pencil, specifically looking because of cash flow.
Yeah, I can even imagine, like how we talk about on the show, five profit centers, right? It's cash flow, home price appreciation, tax savings, rent pay down, inflation hedging, inflation profiting, right? So like seems like seems like the inflation hedging profiting might be the one doing the best right now comparative to the past. But when you look at kind of like cash flow versus appreciation, if you are in a if you're in a cash flow market now, that cash flow has gone way down, and a market that wasn't appreciating that much to begin with is also kind of like slowed down as well. If you're in an appreciation market that was negative cash flow, now you're like even more negative. It's even more painful, and the appreciation to slow down. We talk about Jacksonville being a cash flow plus appreciation market, and we've been at a place where we have slightly positive cash flow, good appreciation. This kind of like flips it into, if you're buying the rate on the street right now, it's going to be hard to find positive break even to positive cash flow in Jacksonville right now, given the fact that home prices have appreciated so much. The rent and the mortgage payment are not going to like cancel each other out. So it makes it a decision now where people are walking in thinking, I'm going to go in negative cash flow to bet for appreciation and then get cash flow later in Jacksonville.
Usually they don't make that decision. Usually negative cash flow is a deal killer in the
Yeah.
minds of a passive income rental property investor. If they're focused on the Jacksonville market and they're buying at today's current interest rate environment, which is like 6.5% interest rates, they usually go down two paths. If they what they'll do is they can put a lot more money down. You can put 30% down or 35% or 40% down. And then even at 6.5% interest rates, you're still going to be cash flow positive. So many people will go down that route. If they don't have the ability to find, to have that capital to put that down, that increased capital, then sometimes what they do is they go down the route of going into neighborhoods that are lower income, that have lower purchase prices, that on paper look like they produce positive cash flow, but through experience, and I know we have many experienced investors in the audience here today. I'm sure they'll chime in and tell you too in the chat. What they generally find if you go into low income neighborhoods, the maintenance costs, the vacancy costs, the property turn cost, all those expenses eat up whatever positive cash flow you put on that fancy little spreadsheet. So they go to a lower income neighborhood. They get away from workforce housing or middle income. And many times they learn a hard lesson that way. Um, the other alternative is sometimes they just take more of an active route. And so sometimes people say, you know what, I want to go and find my own property, and that way I can get a little bit of a better deal. And so then they end up spending a lot more of their time, whether or not they're more successful doing it that way. Each investor is a little bit different, but it's just at today's interest rate environment, it's just not possible for the model to work in Jacksonville and in many parts of the country when it comes to 6.5% interest rates and positive cash flow. It's just not there. It's just that's what the higher interest rates do.
Okay. So now you just like raise my anxiety as somebody that is trying to like build a portfolio to retire on. And I'm, like, me, I'm kind of like on this part of my career where I have time to grow my portfolio. I'm looking for things to invest in. So is the answer to then go look for a cash flow positive market if I like the Jacksonville thing? Like what are we doing here, man?
Do you think I like scared people with how flippantly I just said that?
Yeah. Yeah. That's like the most negative I've ever heard you, man. Yeah.
I'm just being real. I mean, the big caveat there is I keep saying at today's current interest rate environment. So obviously, all of our JWB clients, you guys don't have to worry. We're miles and miles ahead of this. We've been thinking about this for forever, and you guys have seen us consistently look at your investment opportunity. And I've been up here for 5 or 6 years, and I've always said, hey, listen, this is a good time to buy with JWB. And so you don't have anything to worry about. This is a great time to buy when you have a partner who thinks about your return on investment and your positive cash flow as the end result here, and they work backwards. And they put a pro forma together and they negotiate with their lending teammates and their insurance teammates and the costs that go in and negotiate on your behalf to be able to come up with solutions so that they can produce cash flow positive investments at the end of the day that are going to be able to serve your retirement or serve whatever financial outcome is. And you guys know that's the way that we operate. We've been operating that way for 20 years. So sorry to scare all of you if I just said it so flippantly and just left that cliffhanger out there. Pablo and I, of course, are going to walk you through how this works for you. So for JWB, like we can't just be subject to the whims of the market, right? If we're going to be here to produce a financial outcome for you, and we're going to help you get onto a buying plan where you can buy one or two or three or five properties a year, we can't just have an answer for you in a year when you say, hey, I want to buy 5 assets and say, oh, well, you know what? Interest rates are too high. Scrap that plan. No, we're here to serve you for 5 years, 10 years, 20 years. So for us, we always work with the end in mind, and then we work backwards. And so That's what we've done. We've been working with our partners, our lender partners for sure. We're excited to talk about what we've been able to secure on behalf of our clients. Pablo, a couple of weeks ago, I think you shared the 3.99% interest rate, which is, I'm going to say that again. It's a 3.99% interest rate. It's fixed for 7 years for you and for your rental properties. That's what we've been able to do, along with continuing to waive the first year tenant placement fee. At the end of the day, what this does is it sets you up for positive cash flow, sets you up to continue your buying plan, whether it's your first investment or this is your 10th. You can continue to operate in this beautiful little bubble that we have where you're still cash flow positive. You still have an above average return on investment, and you're with a partner who's produced for you for 20 years and can protect that client experience. So there's the full answer there, Pobs, not just the
Thank you.
cliffhanger.
Thank you. Yeah, no, it's interesting that you announced this idea that you went out and negotiated this rate, this 3.99% rate at a time, before this headline comes out and all this happening, right? Like, because like that to me, that would make me feel, again, like my options are getting worse if I'm just sitting here thinking about like I got to wait for the economy to be okay for me to continue down my retirement plan of like what I'm buying and stuff like that, right? So this 3.99% rate, what we want to do today is go through and like show you exactly how that works from a cash flow statement if you're gonna take advantage of that. But what I hear as somebody that's in this like active cycle of like still building my what is the acquisition phase, the way that Saran said it, right? Like
Hmm.
I'm in my acquisition phase still. It allows me to think, okay, cool. If whatever mortgage rates are going to be doing over the next like year or two or whatever, like I can now secure this thing on my own schedule, continue to build this thing, not have to be in negative cash flow positions in the individual asset because this rate allows for that. And I'm just kind of like sitting pretty, waiting for like everything else to normalize around it as this goes on. So, do you want to jump into kind of like the case study right now, or is there anything else that you want to
Yeah,
explain as
yeah.
far
Let's
as
do
like
that.
how this works? Yeah.
Let's do that as you're bringing it up. I'll just kind of share what the feeling that I always want our clients to have is that when you are ready to make that next purchase, it is the same core investment with the same principles, with the same five profit centers, and it's like you have the answers to the test. You're investing in a model. The property more or less is just a widget. You're investing in a model. And so we always want to kind of standardize, right? To replicate this thing, this beautiful investment model that we have with single family rental properties. And so no matter what gets thrown at us, interest rates or more home price appreciation, less home price appreciation, we just want to be that constant in your investment portfolio. And so that's what you're going to see, even as interest rates have spiked higher than we want. And the war in Iran is, unfortunately, it's not closed, it's not over, right? None of that really matters. You're insulated from it when it comes to a JWB rental property investment.
Got it. All right. So then let's take a look at the numbers, right? So this is a typical Jacksonville workforce housing property. It's not typical in the sense that this was actually built by JWB. As you can see, you can recognize one of their floor plans here, typical style of JWB here. Purchase price of $280,020 in one of JWB's neighborhoods here, 32205. Estimated monthly rental income, so the rent price of 1688. This is a 4 bedroom, 2.5 bathroom, 1,752 square feet. The taxes are here, the insurance is here already put in, and the estimated annual property management fees are here. So essentially, this is a monthly rental income of these are property management fees, right? Do you see? Do I need to stay on this thing, or do I go to the next one? Do you want anything?
No, this is I just pulled this straight from our available inventory.
Okay.
So this is not just representative, but this is an actual live property that our clients are talking on the phone with our sales team about now.
Got it. Cool. So now this is the current environment, right? Like if interest rates are at 6.5%, they're going up likely. And if you look at it, it creates this negative cash flow environment. You're looking at like an IRR of 8.3%. That's fine. That's good. That's a good return. But you're looking at going into a monthly scenario where you're starting off as negative $274. Do you see what's the problem with going into negative $274 in cash flow by buying a house?
A few problems. It's just not peace of mind, right? You have the opportunity to invest in something that produces some positive cash flow every month for you. That's nice to see, but you just don't want to get into this investing in liabilities. You don't want to invest, especially not for your first investment, in properties that you have to pay money out every single month. And where that really hurts you as you progress from the beginner stage into the advanced stage, and your portfolio now has 3 properties or 5 properties or 10 properties. Well, if you go negative cash flow, $300 a month on one property, you might be able to afford that. But if you do 10 properties that way, that's $3,000 a month. And that's where you start to really get some stress. And so it's not good to go negative cash flow right off the bat. And especially it hinders your ability to scale. It hinders your desire to scale.
Yeah.
But this just goes to show, we get a lot of questions on the show. Hey, Greg, what about negative cash flow? I heard that there's negative cash flow in Jacksonville and other markets. Is this negative cash flow? And I wanted to put this together for all of you to just to lean in and show you, yeah, in today's current rent environment, you guys are 100% right? If you're just buying a rental property off the street in a workforce housing neighborhood in Jacksonville, Florida, you probably are negative cash flow. Now,
Yeah.
obviously, we have a solution for that, and you can find solutions for that. You can find a partner who thinks with the end in mind and will be able to do that. But absent of working with the right team, this is what it looks like for investing in rental properties today in workforce housing in Jacksonville.
Yeah, it's super easy to see the city of Jacksonville, see its bright future ahead of it. Listen to like the show we did with Nick at the port and be like, man, this is the future. I want to invest in it. It's easy to fall in love with the JWB operating model and trust JWB to operate it well. Really, really hard to stomach the idea that I'm paying $274 out of pocket every single month until like an unforeseen future on my day to
Mhm.
day, and especially if I want to be adding more and more of these, right? So you add, and so now that's at 6.5% interest rates. This is at 3.99% interest rates. The whole kind of like the numbers really, really shift. You get to an IRR of you go, from an IRR of 8.3 to an IRR of 13.2%, and you go from a negative 274 in cash flow to a positive $221 in cash flow when you get this 3.99% interest rate in the first year of PM fees waived.
Yeah, brother. This has been over a year in the making. Being able to secure this interest rate is something that I haven't seen another provider be able to do. So real credit to our team and to our lender base. Really excited to do this for clients. This is a product that has a 3.99% interest rate. It's fixed for the first 7 years, which lines up perfectly with the equity harvest and equity deployment and property baby strategy that we have. And so it totally flips this from in the normal current environment of a negative cash flow property to the positive cash flow property, not just break even. It's actually much higher cash flows than we've even seen really over the last 6 months or a year. Cash flows were somewhere around generally around, I don't know, $50 or
Yeah,
$100 a month in your,
yeah,
in your initial year. Well, so
yeah.
now we're going right back to, 150, 200, even higher than $200 a month cash flows day one when you close on the asset. You're now at a 13% return. Your money's working at a 13% rate of return each and every year for you. Like that's really, really good. And then the best is yet to come. Pablo, you bought your properties about 3, 4 years ago or so,
Hmm.
right?
Yeah.
Have your rent gone up? Has your positive cash flow gone up since year one?
Oh, 100%. 100%. I mean,
100%. So,
my cash flow at the time was maybe a little bit south of this and, per property. And now it's like north of this per property
yep,
in
yep,
2021, right? When the deal was the debt and you were able to like get in there with good cash flow. Like I look at this IRR, I look at this cash flow and I'm like, dude, this is, this, this is as good a like a short-term number as I've ever seen since I've been hosting the show.
exactly. That's why we're really excited about it. So
Yeah.
this is a new lending product. And so that's why it's only available for 5 loans, for 5 client purchases. It's because we really are testing this out and we are testing the demand. We're going through this with our lending partner. And that's why there really are 5 slots. When on the back end here, what's happening is that you actually secure a certain amount of dollars for mortgages in order to be able to do this product. And so it really is limited to $1 million of loans, which really comes out to about 5 loans. So that's kind of where we're at right now. I'm really excited about it, though. I hope it's something that all of our clients take advantage of. It's available for new clients. It's available for current clients. And depending on how this is received and how this what the demand is, we'll have to see if it's available going forward. But I hope it's something that you guys really just jump on. I just think this is a great opportunity. And when's the next time we're going to see a 4% interest rate? I don't know if we're going to see that any anytime soon. So
Yeah.
great opportunity to lock in that interest rate for the first 7 years.
Yeah, man, when I see this, I think of the first thing that comes to mind is this is making vertical integration real. And by that I mean when we talk about investing in rental properties and we talk about the difference between like a typical turnkey provider that's like, hey, I'm just giving you a functioning deal and here you go, voila, versus somebody that's like fully vertically integrated to control the whole experience. I think of the idea that not only have you had to essentially build a business that allows you to bring forth rental properties at my schedule via construction, even at the hardest times, right? Even during COVID, when like nobody had inventory, you guys had inventory and everybody could buy because the conditions were so good that everybody wanted it. But now you're also thinking through this idea that like, man, if we are selling people on an idea of retiring through the cash flow from rental properties, then we have to be able to continue to provide buying opportunities no matter what the market is throwing at us. And now it's not a matter of supply in the market, it's a matter of creating this demand, like creating this like condition where you're able to like buy something and it doesn't feel horrible to buy it. It actually feels extremely positive to buy something and be like ahead of the market when it comes to when it comes to where your rate is and where your cash flow position is and what the prospectus is that you're buying on day one. To me is like a perfect example of like what makes you guys different from everybody else. It's that you think about this stuff. You're not just like, well, I guess, you just gotta stomach it and trust me, this is the plan that you set out and to do. It's like, no, no. In order for you to like get there, for to truly get there, we have to make like the buying situation for you evened out the same way that we've evened out every other part of the experience as well. I think it's really impressive, man.
Well, thanks, man. It's when you've been around for 20 years and you intend to be around for a whole lot longer than that, you've got to think through things that other startups and just brand new businesses just aren't even, it isn't even on their radar. Most brand new businesses, startups, rental property providers are just trying to survive.
Yeah,
And,
yeah,
we are here to serve. And we got big goals to serve for you, for our clients, for whatnot. And when you start, when you have that responsibility, you think differently. And so
yeah.
that allows us to think with the end in mind, work it backwards, work with our incredible network to say, how can we come up with solutions in an environment where interest rates are higher? And here's where we are today. So it's really this interest rate is the solution today. And it's something we're really excited about. But the foundation, I've been up here for 6 years and I've told you that we're cash flow positive. There have always been, and there will always be solutions for us to be able to provide these types of assets with the client experience that you want so you can build your financial outcome around it. And that's one thing you can count on us for.
Love it. Yeah. And you're saying like some startups are just trying to survive, even if they were thinking beyond trying to survive. What I'm hearing in you is because you've been around 20 years, because you've been doing this for so long, because you're at the scale that you are, what I'm hearing is you've essentially gone to your providers and said, hey, I know it's hard for you to sell mortgages too. If we can guarantee you a certain amount of like deal velocity and ways to like get new mortgages, you offer my clients this deal. Like you have to have like a certain scale to be able to like accomplish this. It's not just mindset, it's also kind of like capacity scale that you work at. And I'd love to kind of like ask a couple more details from the community here about how this thing actually works, unless there's something that you need to clarify there from what I said.
Now, let's jump into it.
All right, sounds good. MJ from NJ wants to know, does this include does this cash flow include PITI, management, vacancy, and maintenance?
Yes.
Yes. Okay. Linda Evans wants to know, are these numbers with 30% down? Like what, or like what do the numbers look like with 30% down?
These are with 25% down. So,
Mhm.
and you can put 30% down. If you want to put down 30%, your initial investment would go up. Your cash flow would go up. Your return on investment would go down slightly.
Got it. Your IRR, or yeah, yeah, your return on investment will go down slightly because it's less leverage, right? Like you're getting less
Exactly.
leverage, right?
You're putting
Got it.
more of your own money into it. But that is a great solution for some clients as well.
Yep. Great question from Roger Evans. Good product, but what happens after year seven? If the annual interest rates jump up higher than it is now, does that mean annual seven I go negative cash flow?
I'm so glad Roger asked that question. I thought it would be good for us to spend a few minutes talking about this loan product and how you know that you're set up for success here. The model that we subscribe to is one where, ultimately what we want to do is to make sure that you have enough assets in your portfolio to accomplish your financial goal. And if you're like Pablo and others, you buy three, you sit on them for 3, 4, 5 years, 6 years, and then it gets to a point where you have a lot of dormant equity just sitting in the portfolio. And we're going to work together with you to unlock that equity and to put that into a new round of properties, depending on what your goal is. We're going to continue to do that until we reach the desired number of properties. And that's how we're going to help you retire or whatever your financial outcome is. So, usually, somewhere between years 3 and year 7 is the right time to harvest that equity, that dormant equity, and deploy it again into your next round of rental properties. So that's really um, that is the plan. That's the model to follow. So when we look at a 7-year product, we felt this is a really strong thing to do because of all the things we've talked about and because it fits with that plan. Now, what happens if you don't follow that model? Does this still make sense? Well, let's go over how this loan actually works. It's what's called a 7/6 arm. 7/6 arm means that it's fixed for the first 7 years, and then the six means that it can adjust, the interest rate can adjust after 7 years, and it can adjust every 6 months. And so, what would we do in an environment where it didn't make sense for you to? Well, actually, I should kind of clarify. When we harvest the equity, that means that we're refinancing that loan. And so, following the model, you refinance and you would get out of this 7/6 arm into something else, most likely a fixed rate mortgage at that time. And by doing that, you will have a lot of positive cash flow at that time because your rents would have grown up until this point. So that is the first option to harvest and then deploy the capital and do that model. Let's just say that you don't want to harvest the equity and deploy the capital. You just want to do what's called a rate and term refinance. Well, at any point, you can refinance over those 7 years or later and refinance into a different fixed rate loan. Our team would be here to help you do that as well as connect you with lenders in our network. So we're on top of it, and it's something that is that is also a good plan. But worst case scenario, what happens? What if you just kept this loan in place? Well, there is a rate cap on this loan, and there's a max for what the amount of interest, what the max interest rate could be. I researched it. It's a 515. What that means is that your initial rate increase can't go up more than 5% over the initial rate, and the lifetime maximum interest rate on the loan cannot be more than 5% higher than the initial rate. So, all that being said, the maximum rate on this loan lifetime could be 8.99%. That would be if rates continue to go up and up and up and up and up. But guys, we have 7 years. For the vast majority of you, we're going to take care of option one, which is harvest the equity, refinance out, redeploy, help you grow your portfolio. There will be some of us who we're just going to refinance and put you into a rate and term refinance at some point over those first 7 years. And in a worst case scenario, your cash flows grow for those 7 years. So it's not like you haven't received more positive cash flow in an interest rate environment that could go a little bit higher than 6.5 or 6.75 like it is today. Well, you're still likely to be in a cash flow positive situation even in the future.
Okay, that is that's a bunch of different scenarios. What I'm essentially hearing is in 7 years, we expect for the home price appreciation to have gone up, right? We expect for downtown Jacksonville to be a completely different place than it is today. And therefore, like everything that we're talking about, that we're investing in, all these different things are going to continue to like compound and go up. We expect for people to continue moving to the southeast of the United States. We're going to expect to continue to see people moving to Jacksonville, continue to be a attractive growing market, which means there's going to be more and more demand for rental housing, which means that cash flows are going to continue to go up because that is a positive force on rents as well. And then once this thing hits in 7 years, there is a there's a good likelihood that interest rates are not higher than they are today, right? At that point, it's like a pretty easy decision to like refinance and lock in at that one. There is the option to do the financial engineering that we all like to do of harvesting that equity, putting that new loan in place, acquiring more properties, even putting that higher equity into like another higher returning thing that provides more cash flow to like make up for like whatever needs to happen there. And that all that put together means that the idea that in 7 years you are likely going to be in at least a break even to positive cash flow state is high, is what you're saying.
I look at all of the potential wins here, and I compare them to the potential downsides, and I think the combination of the wins with the optionality and the solutions far outweigh the potential downsides. I will also add, for some clients, they just really want a fixed rate, and that's okay. Any client can still decide to do the fixed rate product. Um, it will have a much higher interest rate than 3.99%, but JWB will still put together an incentive package for you. So if you are the client who says, you know what, I just want it to be set in and forget, I just want to have a higher interest rate, you can take an incentive package, which is worth thousands of dollars, and it's interchangeable for us. So you really are in a good spot no matter what for, and I don't like to make blanket statements, but I look at this opportunity as a 3.99% rate for the first 7 years, and I know all of the wins that come from that, as well as the options to be able to protect against the downside, and I think it's a great opportunity for you. But if not, you're taken care of either way because you can get a lump sum of incentive dollars.
Yeah, that makes sense. And Michael Santorius brought in a good analysis here in the chat, saying assuming a 4.4% uh 4.4% appreciation rate for 7 years, a $280,000 home would be valued at 368,467 with 25% down payment at 3.99%. After 7 years of loan pay down, property appreciation, you're looking at about $187,000 in total equity. And Gregg actually put in a slide here to talk about what it looks like in 10 years, right? GC, you want to talk us through this slide?
Yeah, absolutely. I always want you guys thinking beyond interest rates, beyond year one cash flow. I want you to look at these beautiful rental properties as what they can do for your financial outcome 10 years down the line and start building up your army of income producing assets. So this is that property on Ottawa Avenue. If we start to think about what this is likely to look like in 10 years, start to think about the fact that home prices do go up at a regular a historically accurate rate. And in Jacksonville, it happens to be 4.8% per year. And you give it 10 years on average, it's going to be somewhere around there. So this property value is likely to be somewhere around $450,000 10 years from now. Rents likely to go up at around 4% a year. Well, that puts this rent at about $2,500 a month. Remember, for the first 7 years, that interest rate payment is fixed. So rents now are $2,500. So that is that additional cash flow that you're earning. And for somebody who buys and holds this asset, at the end of the day, you would have put in about $80,000. You would have received about $170,000 in portfolio returns, profits. And that means your portfolio value is estimated to be at about $250,000 at year 10. And again, that's what happens when your money works for you over and over each year at a 13% rate. That's what this allows you to do, and that's the beauty of this model. So hope you guys take advantage of it.
Man, a lot of interest here in the chat. A lot of good chatter. I'm gonna hit you with just a couple questions that have been asked. Alejandro Diaz asked earlier. He's been super patient. The 3.99% is for this type of loan. What about a DSCR loan? Does this apply for DSCR loans?
It does not. And that's where we are always going to take care of our clients, even if you can't qualify for this loan. This is a conventionally financed loan. And so there will be some clients that can't qualify. Like Alejandro is talking about, DSCR is a non-qualifying type of loan, or if you're buying in your retirement accounts. And so that's where those same incentives that JWB has offered, the cash flow credits and things of that nature, that's how we're still going to take care of clients that can't qualify for this loan specifically. So you're going to get taken care of either way. It's either starting off with a couple $100 of monthly cash flow year one, or you get that incentive package, which you have seen really over the last 6 to 12 months, which is pretty substantial. So you're taken care of either way.
There you go. My tocayo Pablo Tolentino is asking, is this for a 30-year fixed loan? No, Pablo. This is for a 7-1 loan. That's what it's called, you see?
It's called a 7-6 loan,
Seven.
but close enough.
Not a numbers guy. All right. Not your average guest is asking, are you locked in for 7 years? Is there a prepayment penalty in under 7 years if you're going to like change something in your loan?
There's no prepayment penalty. You are not locked in for 7 years.
And the mystery man, Denny Davis, says, Pobs, my wife is sitting on two 10-year ARMs on two JWB homes, and we are not even concerned. So many options between now and then, including the loans, if it makes sense. That's Denny Davis's take. Not a question.
That guy knows what he's talking about.
That guy knows what he's talking about. All right, GC. And man, there's a question from an anonymous attendee here that was earlier today. It says, I think some tenants know that landlords are desperate to get their properties rented in this market, so they exploit it and don't pay their rents for months, and that forces the landlord to evict after they've lost rents. What are your thoughts about this?
Well, I can just share what we're seeing here. We manage about 6,000 single-family rental properties here in Northeast Florida, about 7,000 total. And our occupancy, incredibly strong. We're over 98% occupancy. Our rent collection, incredibly strong, over 98% rent collection. Our eviction or early move-out percentage, right in line with our historical standards, which is way low compared to others. So while that may be true in some settings, it's really property management company specific or landlord specific, and we're not seeing any of that for JWB.
Yeah. Okay. I haven't brought this up all show, but we still have like 70 people on. Anybody who wants to take advantage of this loan, what do they do? Are they just calling JWB, go to chatwithjwb.com and booking a call?
Yeah, chatwithjwb.com is a great place to go and schedule a time to speak with our team. You can just send a text. We haven't said the text number in a while. Let me see if I remember it. 904-293-0341.
You got
There's
it.
a member of my team. There's a human on the other side. So if you want to text any question or set up an appointment, that's a great thing to do. Send an email to sales@jwbcompanies.com. If we haven't had the opportunity to speak with you yet, looking forward to building the relationship. And if you're a current client, just reach out to your JWB portfolio manager. They're happy to chat with you about all the finer points of this and get you set up for your next round of investments.
And Karen Patterson, last question here, asks, do you pay out the portfolio return so we can pay the taxes?
So what actually happens for the vast majority of purchases and loans is that your property taxes and your insurance are actually escrowed. That means it's a part of your monthly mortgage payment, and your bank, your mortgage company actually pays your taxes for you. And so, yes, we pay every month. We distribute the rent that we collect minus the property management fee. We send that out to our clients. So either way, yes, you have the money to be able to pay your taxes, but most likely it's paid by your mortgage company because you pay it on a monthly basis when you pay your principal, interest, taxes, and insurance.
All right, you see, we haven't done it in a while, but we went over it today. I think it's been a really good show, right? Starting off with this news of interest rates going up and how that's going to affect the economy and how that's going to make it really, really tough to, like buy rental properties today, but this innovative solution that JWB as a vertically integrated company comes up for those of us that are counting on a consistent approach to retirement through rental properties. This 3.99% rate seems like a really, really good opportunity for anybody that's been wanting to add to their portfolio, buy their first new rental property, and do it at yesterday's rates and lock in better than yesterday's cash flow and a really, really nice IRR. So I appreciate you sharing that with us today, GC. I appreciate everybody being here, man. We had like 70 plus people here for over an hour today. And the ticker kept going up. Like I think we got into the high 70s at a certain point. People were joining the call. I think they were figuring out that like, wow, there's a way to get into this thing without dealing with the ills of today and not being on the roller coaster ride of like waiting to see when interest rates are going to drop and or if they're going to go up, and just opting out of all that noise, getting into a necessary asset for society. What is it? I'm losing what it's called. It's rental property. Workforce housing is a necessary something or another.
A critical
A
need.
critical need. God, I can't believe I forgot. Investing in a critical need. This is what investing in a critical need with a vertically integrated provider looks like, right? It creates a consistent scenario whether the economy is good or bad, right? Like to me, that's the number one lesson here. Next week, speaking of investing in critical needs, Berkshire Hathaway just bet $8.5 billion into a housing market play. We're going to talk about what that is. We're going to talk about what Fannie's predicting as a recovery, and we're going to go into a couple more of our not sure average insights from today's headlines. It's going to be a fun one. Don't want to miss it. GC, any advice for people from now till then?
Don't be average. See you, everybody.